the HFAC comp. In the last video, we talked about ROIC, the return on invested capital, and we talked about some guideposts when you want to approach analyzing a business. NCIS, the network effects, cost advantages, intangibles, and switching costs of a company. Remember, those are just guideposts to inform the way you might want to think about a business qualitatively. Today, we want to look at some more formal frameworks that have been in use for some time to analyze a business or an industry. The first framework we're going to look at is called Porter's 5 Forces. It was developed by Michael Porter over at Harvard Business School in 1979, and it really has withstood the test of time. Now, Porter's 5 Forces is more at an industry level, so you might need to think about a specific company, but what you'll notice is if you're trying to compare it against different peers in the same industry, different companies in the same industry, that it's going to look pretty similar. So that's just something to be aware of. Now, I like to really explain Porter's 5 by example. So throughout this video, let's look at an airline as an example. Maybe an airline like Delta or United. And again, like I said, this is an industry level, so you'll really notice that it's going to be the same for United, Delta, or American Airlines. So let's start with the first force in Porter's 5 Forces, which is the threat of new entrants. How hard is it to start an airline? Well, it's pretty hard. It's expensive. Airplanes cost like hundreds of millions of dollars. There's a lot of regulation and red tape. And you need to bargain for and bid for landing slots at airports and stuff. So it's not like an easy task to start a new airline. In fact, in the US, I think it's only been like one airline that has been started in the past 20 years that is still around today, and that's like JetBlue. So yeah, starting an airline, pretty hard. The next force that's pretty important is bargaining power of buyers. How much bargaining power do buyers hold in purchasing airline tickets? Now, they actually hold a lot of bargaining power. Why? Because consumers for airline tickets are very price sensitive. If it's too expensive, they're simply just not going to travel. Or maybe they'll look at a different airline. Maybe instead of flying Delta, American, or United, they'll fly Southwest or Frontier or Spirit because they're extremely price sensitive. They're going on vacation. Maybe they'll just not go at all. Maybe they'll push out their travel by a few weeks. So we tend to think about the bargaining power of buyers is related to their price sensitivity. And for airlines, it's pretty high just because travel is normally not necessary in most cases. The next factor is the threat of substitutes. Now, this one's pretty easy. How hard is it to substitute air travel? I'm going to go on a limb here and say it's pretty hard. Like, if I want to go from the east coast of the United States to Europe, I mean, I could really take a boat or I could take a plane. Taking a boat would take a few weeks, and it's probably not going to be any cheaper. So the threat of substitutes in that case is pretty hard. It's pretty low there. And even for flying from the east coast to the west coast, you can take a train, you can take a bus, you can take a car, you can't really take a boat, but it's still going to be a lot slower. So it's pretty hard to match against an airline there or an airplane. So the threat of substitutes is going to be low. The next one is the bargaining power of suppliers. This is pretty interesting. So this is how much pricing power do suppliers hold when they're selling to the company or industry in question. So for airlines, we might want to think that the big thing that airlines need is oil. But oil is like a market price here, so there's not much the airlines can do about it. There really isn't bargaining power. The oil price can go up, true, but it's not like airlines will just have to raise their ticket prices in response to that. So we don't really want to think about that as a factor here. The more interesting thing to think about airlines are these third-party vendors that airlines might use. Who provides the food on an airplane? Normally, it's not the airline itself, but it's contracted out. Now, you might think that the bargaining power of these suppliers is pretty high. If the airline doesn't want to pay, they're not going to get any food. But in reality, there are not that many airlines for these suppliers to service. So if you look at Miami International Airport, a majority, like 80% or something, of all air traffic in that airport is American Airlines. If the company that makes the food cannot service American Airlines, they're going to pretty much go out of business. So the bargaining power of these ancillary services for airlines is actually pretty low, just because there's so few airlines, and that relates back to the threat of new entrants. It's pretty hard to start an airline. Our final force, which kind of combines everything together, but is the most important, is the rivalry in the industry, or the rivalry among existing competitors. How many different competitors are there, and how fierce is the rivalry? Are they all selling the same product, or are they selling different products? For airlines, it's pretty high. Why? You have a lot of airlines that serve a lot of the same routes. If I want to go from Miami to Boston, I can think of several different airlines I could fly to take me there. So as a consumer, I'm probably just going to choose the one with the lowest price, which is the bargaining power of buyers there. So in that sense, the industry rivalry is quite high. These are 5 factors that we can look at to think about a company or an industry. And this is, again, a good way to guide your thinking. You cannot predicate a whole stock pitch or a whole reason to buy stock in a company based on just these 5 factors without much detail. So remember, you want to use these factors as a way to start to delve and segment your thinking to help develop a prudent, clear investment thesis. Another framework we sometimes use, which I'm not the biggest fan of, but we still talk about it because it can be helpful in some cases, is SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. It's pretty straightforward. S, what are the things that your company does well? What are some qualities that separate you from competitors? What are the sustainable competitive advantages that we talked about in the last video that your company has? Those are your strengths. Weaknesses, what are things your company lacks? What are things that your competitors do better than you? Opportunities, how can you expand? Are there any markets that you're not serving that you want to serve? Are there any groups of consumers that you want to try to serve better? Can you better exploit pricing sensitivity in different groups of consumers? Those are opportunities. And threats, what are emerging competitors in the industry? Is there a changing regulatory environment? This is actually very important, and we see this in big tech right now. And as an airline, a big threat right now is COVID. So these are all different threats. So that's SWOT, strengths, weaknesses, opportunities, and threats. And that's another good way of, again, guiding your thinking of what makes a good business. So this covers our second video on what makes a good business. In the first one, we talked about NCIS, network effects, cost advantages, intangibles, and switching costs. These are, again, all good guideposts for guiding your thinking when you want to think about a company. In this video, we talked about Porter's 5 forces, and we talked about SWOT. These are, again, 2 a little more formal frameworks that have a more of an academic background for thinking about companies. But overall, a qualitative thesis for any company, why would you want to buy that company on a qualitative basis, is going to be very company specific. So you shouldn't rely on these in a general term. You really need to delve into the specifics of the business. For example, if I want to buy a company that's pretty new to the stock market, maybe recently IPO'd, maybe it's a company like Uber or Lyft or DocuSign or AlterX. These are tech companies. These are companies that may not even be profitable right now. Why would I buy them though? Again, this goes back to what we talked about in our kickoff. It goes back to investing is about expectations. So what is the qualitative aspect here? They're growing pretty fast. These companies may not have any revenue, but they have a vision for something. They're introducing a new product line. They're innovative. These are intangible aspects that you can't really put a dollar amount on. Another good thing to look at for startups and companies that are pretty young is the management team. Do they have a vision? Have they been able to execute on this before? If you're investing in a startup and you want to take that startup to an IPO or an initial public offering on a stock market, you normally want a management team that's done that before, because that can sell the success of an IPO or the failure of an IPO in the long run. So these are just some other factors that you can take into account. Management, vision, innovation. Those are other aspects that make a company a good business, even though it's very hard to quantify it on a financial statement. So what have we seen here? We've talked about a bunch of ways how to guide your thinking about analyzing a company qualitatively. And the goal of this and throughout our comp is to develop an intuitive sense as to what makes a good business. Some of the best investors in the world can very easily tell you that this is a business they want to own and this is a business they never own. And that's where we want to get you by the end of the comp. All right, that's it for this video. We'll see you next time. Have a great week.